Good afternoon, Hinge friends. Thanks for joining us today with a conversation about real estate strategies. So, as you guys know, we have dedicated this entire year to a growth series. We are hearing from the majority of our friends in the industry that growth is big on their mind, that they're doing well, demand is stable, enrollment is stable, revenue is up for most, so that's good news. And when we're doing well, growth is always front and center. We'll also talk about how to extract your value from your real estate and how to think about it separately from your business. So for some people, there are realizations when they consider that their business and their real estate are two separate assets. They should be thought about separately. They should be strategized separately. They can be bought or sold separately. So if you are or you want to be a real estate investor, then think about that separately from your business. So we're going to dive into some of the concepts. Please feel free to ask us questions. You can put those in the chat. Love for you guys to say hello. I will open my chat so I can follow along. I'm excited to introduce you shortly to a Hinge guest speaker. So I'd like to start this conversation with a poll. So if you are in growth mode, and most people are in some phase, unless they're exiting, you're in some phase of thinking about how your company is going to continue to develop in the future. So go over to polls, over to the right of your screen. It should pop up. And let's think about this. Unless you're absolutely not intending to grow your company and then you're going to exit, you may think about this too. But you may be thinking about leasing additional properties. How are you going to grow into existing properties using a landlord's money and leasing? Are you going to purchase real estate? So I'm a big fan of real estate ownership. We're going to speak in a bit about the pros and cons of that. But if you're going to purchase, are you planning to use SBA financing? A large part of our population grows in that manner. Are you going to use traditional bank financing? We used to say SBA was great, but very difficult to get through. It's all difficult to get through now. You know, both types of financing is very bureaucratic now. Are you going to partner with a REIT, a real estate investment trust? We'll speak more about that. If you're not aware of what that is, hang on. We got you. It's a great growth vehicle. And maybe you're just not sure. Maybe you want to grow, but you're not sure what the options are yet. So looks like we've got a really good mix of respondents here. So our majority wants to purchase and intends to use SBA financing. Interesting. Slightly behind that is also purchasing, but using traditional financing. So more than 50% of the growth, 58%, will be from purchases of property. Behind that would be 20% to lease property, 13% who are not sure, and 7% who feel like partnering with a REIT or a real estate institutional investor is a good route to go. Interesting. Thank you. Thank you for that. That helps tremendously. So I would love to introduce a person who I have a tremendous amount of respect for on the Hinge team, as a person who knows and has worked in various forms of real estate for many, many, many years. And that is Mike Pepper. There is Mike Pepper. Hey, Mike.
Hi.
Thank you for joining.
Thank you for that kind introduction.
Yeah, so Mike is a 10, we argue about this, 10 or 11-year team member here at Hinge for about half of the life of the company. And Mike has invested heavily in the industry both before he began his career at Hinge and now at Hinge. So Mike, could you take a minute and tell us about your background that led you to being a person I consider to be an industry expert in real estate in the early education space, and also the opportunities you found along the way and what you invested in?
Thank you. Thank you, Kathy, and hello to everybody on the webinar. I've been in the real estate business world since 1984. Please don't hold that against me. Been through, I don't know, 7, 8 presidential administrations, 6 or 7 investment cycles, and I'm still here. I still love it. After I got out of college at Stanford, I worked for an apartment syndicator, then I worked for a bank, then I worked for a pension fund administrator, different investment houses, as a developer. So I've had a wide variety of hats, from a investor to lender to a broker. So been able to see a lot of different aspects of the commercial real estate world. And many of you have heard my story before. When I was living in Colorado, I was running a development shop. We were building office buildings and industrial buildings, and one of our tenants was a early childhood education operator, and their headquarters space was in my office building. Their locations were scattered around the Denver market. And so in talking with this lady, we ended up striking up a relationship, and we built several schools on her behalf. In the recession of 2008, 2009, when those projects ran into trouble, we collaborated with Kathy to find a new tenant, and they took over the lease. And ever since then, I've been connected with Hinge and loving it, and love working around the country, helping our clients grow their real estate, dispose of their real estate, and generally just help them to consider real estate as, like Kathy said, a second avenue to growing your overall ECE business.
Awesome, Mike. Yeah, so when Mike and I met, we were on the opposite sides of a transaction, which is when you know you really like someone is when you close a transaction. And I represented the new actually I represented Mike's tenant, who may not have been paying him rent at that time. So we brought a new, very solid tenant in, and it worked out really well for everyone. But I appreciate Mike's work in the industry and on behalf of our clients. So thank you for that, Mike. Mike, I would love to start with a question that we get very, very often. And that question is, with a limited amount of resource and ability to grow, how should I think about the real estate that my early education business sits in? Is it better to lease, or is it better to own? What do you think, Mike? What should we be thinking about?
I feel that the answer is going to depend on the context. And for those that are starting out looking to grow their business, then leasing makes the most sense. And the advantages for leasing at that early stage in the growth of your business revolve around the minimal amount of capital that's needed to enter into a lease and the flexibility that leasing provides. So for those that maybe only have one or two or a handful of locations, the ability to parlay a landlord's capital and to parlay their limited resources into growing their business, then leasing makes the most sense for that strategy, for where those folks are in their lifespan. Now, those folks need to think about how are you going to mitigate the disadvantages of leasing. So the disadvantage of leasing is that you're paying rent on somebody else's building and you're not getting anything in return for it. You could argue you're getting flexibility and you're getting a low cost of capital to get in. Okay, that's true. So usually the advantage and the disadvantage are the flip side of the coin. Another disadvantage, of course, is you don't have a lot of control. You may sign a lease for 10 years. You're going to be wondering what happens in year 11. You may or may not have an option. The rent is probably going to increase every year. Maybe you'll get priced out. And you're going to be paying maintenance and repair on somebody else's building. The new leases these days mandate that the tenant pays for not just utilities and janitorial, but oftentimes repairs, sometimes even replacements. So folks need to be cautious about what is the short-term advantage and compare that to the long-term risk. For those who think that owning makes the most sense, I'm a fan of real estate ownership. I know Kathy mentioned earlier that real estate ownership is fantastic for the long term. And the advantages, of course, are control. It's another way to grow your investment portfolio. There's some tax advantages also from depreciation. And if you control the business, it's quite an advantage to go to an empty building and be able to purchase the building as a real estate investor, knowing that your business can be the tenant to occupy that building. That's why a lot of our more sophisticated clients set up a property company separate and distinct from the operating company. And that's a good way to maximize all of the economic benefits. Now, investors and operators need to be aware of the disadvantages, however, of owning. And obviously the primary one is the tremendous amount of capital that gets tied up in bricks and mortar. So for those that are at the beginning of the life cycle of investing in ECE, you may not think it's worthwhile to invest millions probably into a brick and mortar building and subject to trying to find a loan. Maybe you have to sign a personal guarantee. You have to think about, okay, in 10 years, if I still own this building, will the demographics and the neighborhood still be fruitful for my school? What if the neighborhood changes, that you still own the building? That's a dramatic difference between leasing and owning. When you own it, you may get stuck with it. If you pick the right spot and you have the right financing in place and the economy improves and that neighborhood improves and you're in it for the long term, that could be a wonderful investment. We often see situations where the client's investment in the real estate surpasses the investment in the school. So that's a quick overview of the advantages and disadvantages of leasing and owning.
Thanks, Meg. A couple of comments. Agree that I'm a huge fan of real estate ownership. Also, to me, agree that it's a resource issue, that if your mission is to grow and you don't have the resources to do both, I love, love, love the idea of partnering with a or multiple landlords who can put you in multiple buildings, which they will do if they love you as a tenant. So that's a great source of growth. I'm going to throw a little curveball question that just occurred to me because I didn't feed you this one, but I'm sure you have it, so no worries. Let's talk a little bit about what a standard lease and its terms would look like. So if we are going to enter into a new lease with a new landlord, or we're going to sell our business but retain our real estate. So very often we do this. We have sellers so weary of the business, but we can insert a very stable tenant who will not only be financially stable, but will have a great culture fit with your team and families. What could you expect for your real estate? We're going to talk next about real estate value and rent value. So other than that, because we'll get to that in a minute, what would a typical lease and its terms look like?
Okay, I like that question. And I do find a lot of times that the operators rely too much on their lawyer, or they may not even look that carefully at the lease. So I heard two questions there, and I want to frame the answer by commenting on when we're helping a tenant go into a new building, we want to make sure that the landlord's money is being spent to the maximum extent possible to prepare the building for our future use. And that's often a negotiation between landlord and tenant. And it depends on the type of building that we're looking at. If it's a former school, it probably already has sufficient plumbing. Maybe it has a play yard area. It's probably got decent parking. Hopefully the condition of the structure is in good shape. Hopefully you've got enough classrooms and separate air conditioning set up. So that's one example where you're stepping into a school building. We also have many clients that prefer to buy, or prefer to lease a building that's in a good location, and it wasn't necessarily a school. So there's a tug of war between the tenant and the landlord to establish who's going to pay to fix up the building for school use. So that's an area of conversation and negotiation. Some of the other business terms we would look to advise our new tenant there would be, is there sufficient length of time on the lease? Are there options to renew? What are the economic terms of the options? Is there a way to minimize the personal guarantee that might be required on that lease? Are there other restrictions that are posed on the tenant? For example, you can't have another school within a certain mile radius. We see that. We also want to make sure that the maintenance and repair obligations are pretty clear, so there's no ambiguity. As I mentioned earlier, many of the modern leases are fashioned on a jargon called triple net, sometimes abbreviated as NNN, and that's a jargon describing that not only utilities but also maintenance and repair, sometimes replacement of building components, becomes a tenant obligation. So we want to make sure we understand what are we signing up for from an economic standpoint, and what are some of the operational constraints or benefits that are given from that lease. If the landlord is going to sell that building, we sure would like the right to buy it first. So that's called a right of first refusal. And there are additional legal provisions that we would advise our tenant to inquire with their lawyer about: environmental liability, about other types of operational liability, insurance requirements. There's a reason why those leases get to be 25 pages, and we encourage you to read those carefully and understand what you're signing up for. Now, contrast that with the other scenario that Kathy discussed, where now you've been the tenant, you've been operating a school in that building, you own the building, and you want to get out of the day-to-day business of running the school. So we're going to sell the business and keep the property. So now, instead of the tenant hat, your hat is a landlord hat. And so you really don't want to mess around with anything, any operational part of the business. You don't want to be responsible for fixing anything. You basically want a monthly rent payment, and you don't want to get called if the plumbing gets backed up. So with the landlord hat on, and now you have the ability to write a new lease with the buyer of your business. So in those cases, we advocate, make sure you've got enough credit quality behind that tenant. This is why sometimes it doesn't really make a lot of sense for the school operator to sell it to their cousin or to a startup or to their director. The success of that tenant is not as robust as selling it to a larger, more established company. We want to make sure that the tenant is going to be responsible for paying all of the expenses. We want the tenant's insurance to be strong and robust. If we want to sell the building, we probably are not that excited to give the tenant a right of first refusal. That sort of puts sand in the gears of any process. You can see that the topics that are negotiated, the topics remain the same, but it depends on whose hat you're wearing, where your focus is.
Right. Thank you, Mike. To add a little, see if you agree with what I'm about to say. If I were to add some average specificity to a lease that an operator could either expect to gain on a lease for a property they're leasing, or from a tenant with a business they're selling, basic terms would look like 10 to 15 year initial period with 2 5-year options to renew, 2% average annual rent escalators, maybe 2.5%.
You know, the average, the escalators are a market by market phenomenon. I would argue that in California, New England, Miami, Seattle, you might be looking at 3% annually. If you're looking at Texas,
everyone else,
and well, Texas and the Midwest, I think it depends. We've seen deal structures where the lease is flat for 5 years, and then at year 6 there's a 10% bump.
Yeah, we have. I think those are a little more rare, and agree that, you know, all of the metrics are unique in very high property areas, high real estate areas. Okay, thank you for that. And then also we typically see triple net terms, which Mike mentioned, meaning the tenant is responsible for insurance, maintenance, and property taxes.
And taxes, right.
Sometimes we see some some landlord responsibility for structure or major systems. It depends on the age of those, and we like to arrange a burn off. So perhaps you're responsible, if you're the landlord, for a certain amount of time, and then that burns off. And then the last term to throw out, which is unusual, but maybe more common on brand new buildings, is an absolute triple net lease. Absolute means that the tenant has entire responsibility for every single thing that might go wrong in that building. So those are some terms to think about. Anything to add to that, Mike?
I would encourage the audience to think about the provisions in a lease are always negotiable. Every single aspect of a commercial real estate lease is subject to discussion. Now, you may have a landlord that isn't that flexible, but every single provision is negotiable. There's not a standard format that one size fits all.
Right. Okay, great. Thank you. We're gathering some excellent questions, so we're going to leave 10 or 15 minutes at the end for those. You guys keep them coming. All right. So thank you for that, Mike. That was a big conversation. And like I said, it's probably the question that we get most often. So I did want to put a good bit of focus on that. I'd like to speak next about how to calculate rent. So you guys, maybe you're familiar with the 5 Pillars book, maybe you're going to order it today, who knows? But of our 5 pillars, we started the year with the revenue load, which is occupancy, tuition rates and discounts, create your revenue. Our 4th pillar, which is the greatest expense, is salaries. And then our 5th pillar is your facility cost, because that's your second largest for most people. Excuse me, that's your second largest expense. So I want to focus right here on another question that we get very, very often, which is, what should I be paying for my building? So this is the number one issue, that it is determined in advance of opening, and it's set, there's a lease in place or a mortgage in place, and then we haven't properly, our client hasn't properly lined up the size of the building, the tuition rates, and its capacity to make money with the metrics that are healthy for the ownership or lease of that real estate. Unless you can renegotiate with your bank or your landlord, which is really hard to do, then there's little you can do to get past an issue. So this is a concept that I really like for our community to focus on, and to be sure when they enter a new space, renegotiate a lease, buy a building, that they're very focused on what are the healthy metrics for what I can pay in either a lease rate or a purchase price. So we're going to focus there for just a minute. So the first concept is, what are healthy markers that a business owner should think about as they are considering leasing a space? Talk us through that, Mike.
What are the healthy markers? Is it appropriate to talk about the gross revenue factor first?
It is best to talk about what's right there on your slide.
Yes. Right? Okay.
Yes, I'm sorry.
Okay. So we want to make sure the tenant isn't burdening themselves. We want to make sure the operator's not burdening yourself with a fixed expense on rent that's not sustainable. So this is why over time Hinge has developed this guide where the maximum rent that a business could pay is equal to the 15% of the gross tuition reached at the school, assuming their school is 70% full. And the reason why we look at this is to make sure that we are planning for the long term. If we calculate rent based on the student population being at 90% occupancy, you're setting yourself up for a very difficult fixed rent cost. And if your occupancy drops, then you're still going to be paying this high rent. Conversely, you're probably not going to be winning many battles to occupy a space if the maximum rent you could pay is based on 50% occupied. That just isn't going to win you many tenant, victories. So exceptions to this rule, sometimes in a brand new building, you may go over the 15% level. Sometimes if you have a very old building, you'll fall below. Sometimes the geography has an impact, but this is a general rule of thumb.
Yeah, I'll add a useful tool for you guys is our free framework model that's online. You can go to frameworkbyhinge.com. I'll ask him to drop that in the chat. Once you go there, you can input a school. So I see that at least one of you guys is considering a new school. You can go to the free assessment, drop in your expected license capacity and your expected average tuition rate, choose 70% occupancy, and the benchmark will populate line by line what you should spend in each line category on your financial statement. So just go down to the rent line and that's it. That's what we would expect to be a healthy marker for the reasons that Mike mentioned. So that could be a quick calculation for you guys. Just go grab it online. You can play around with that too as the school grows, or like Mike said, especially with a new school, you're going to build your revenue as you go. So you have to be able to support that rent or mortgage payment in the meantime. So thank you for that, Mike.
So we triangulate, right? So the metrics here, there's 3 metrics that are listed. So that's just one of them. And certainly we start with that one. But we also triangulate by looking at some of the other metrics. And so cash flow coverage is another one, and rent per square foot. So the cash flow coverage is a little bit of a sophisticated analysis where we add back the projected cost of or we look at the profit of the school before the rent expense. Let's do it that way. We look at the profit of the school before you paid rent. And for those of you who like acronyms, that acronym is called EBITDAR with an R at the end. And then we compare that ratio with the cost of rent. And we generally like to see 2.5 times the coverage. If you're at 3 times coverage, you're pretty good shape. If you're at a 1-to-1 ratio, that means you're basically break even after you pay rent. That's not a position anybody wants to be in. We'll come back to that in a minute. And then the last piece of the triangle is the rent per square foot. And so here, this is a kind of a gut check, I'll guess, when we're looking at what is the market rent for other types of buildings in this area. So when I look at this and somebody says, well, how much rent can I pay? We go through these calculations, but we also look at what is a coffee shop, what's a Starbucks going to pay, what's a general retail store going to pay, what's a vet hospital going to pay, what's a medical rent. And so we want to make sure, and those are usually quoted in dollars per foot on an annual basis. So $18 a foot per year would be an example. Now, in some markets in California, they quote that monthly, so $1.50 per month is equal to $18. We just want to make sure that we're not signing up for something. Let's say I'm the tenant and I'm going to be going into a new building, and I go through all these calculations and I realize that I'm setting myself up to pay $58 a foot. And that might be way over the generic market rent, unless there's something special. I'm in Beverly Hills, I'm in Manhattan. Generally, high teens per foot is a decent number in most markets. Sometimes a new build will be $28 to $30 a foot.
Mike, would you agree that, and agree, we can see that anywhere from $12 to $60 a foot, although the average is probably in the upper teens. And with the variable being that if you pass the first two markers, which basically say this business can afford to pay this rent, then that's the most important piece of the puzzle. Is that fair to say?
I think that's fair to say, and we do want the folks to just cross-check all of these, and if you're over the line on one or the other, make sure the others are certainly within the safety zone. A more sophisticated analysis, let's say I'm the landlord and I'm trying to get a childcare tenant in my space, and the most rent that the operator says they could pay is, let's say it's $12 or $13 or $14 a foot. I might not be so excited to bring in that tenant, especially if I, as the landlord, feel that the market rent is in the 20s. And so in those kind of circumstances, if I'm the landlord and I'm willing to accept a lower rent than the market, I probably want the tenant to pay for any renovation cost. If, on the other hand, I'm the landlord and I'm willing to invest money in my building, then I probably would be looking to get the market rent or a little better, as long as I don't create a rent structure that is not sustainable for the tenant to pay.
Right. Okay. Let's look at a quick example. We just plugged some numbers in. So in our example, 70% times 15%. So we calculated, and again, you can use the framework model for this, that our school at 70% full would have a gross revenue of $1.5 million annually. 15% of that is $225,000 in rent annually in a basic triple net lease. We also said that cash flow coverages are most healthy, definitely 2 times plus. 2.5 is more comfortable. We see them in the 4s and 5s, which is great. And rent per square foot in the teens, unless you're in a very high expensive real estate area. So let's move on to, now we know how to calculate our rent, Mike, and we've got a fantastic question here from AJ. And I'm going to read the question as we go, because I think we're going to answer this question for you, AJ. So AJ is a real estate investor as well as an operator. He's asking about property tax and insurance. I will just say that those are typically paid by the tenant. He's coming across franchise companies who are inflating rent and asking a high price for real estate. He thinks the rents are not sustainable. What is your advice? Well, my one-word advice is run. But let's talk about it. So let's figure it out. So now that you understand the metrics, at an acceptable revenue, does 15% of the rent convert into the appropriate real estate value? So talk us through, Mike. Now we know what the rent should be or could be. How do we then know what we can pay for the real estate?
Right. So in the real estate world, we use a ratio called a cap rate, which stands for capitalization rate. And it's another method of calculating return on investment. It's expressed as a percentage. And so the cap rate ranges from 7% to 9%, depending on a lot of factors. So when we understand what the rent is, and we want to figure out what is the building worth, we apply a cap rate. The cap rate is then divided into the rent. So in Kathy's previous example, we had $225,000 as a rent number. And if we felt that the cap rate is 8%, that derives our real estate value of $2.8 million. A cap rate is a function of macro factors, market factors, and negotiation between buyer and seller. It's a when interest rates are higher, cap rates tend to go higher. When interest rates are falling, then sometimes cap rates can also fall. In a couple of years ago, when the 10-year T-bill was in the 2% range, 3% range, we saw some childcare deals in strong markets with strong operators where the bidding was so fierce that the cap rates would fall into the mid 6% range. This means that an investor was willing to live with a 6.5% return on their invested dollars. Conversely, now interest rates have gone up a little bit in the last 6 months, 9 months. And so as interest rates have gone up, cap rates have also gone up. In this example, we believe that the investor would require an 8% return on their money, and the rent number in this example, the hypothetical, is the rent stays the same, and with an 8% cap rate, our real estate value is 2.8.
Great. Thank you, Mike. You guys can see that as the Hinge team works with valuations of businesses and real estate are more of an art than a science. It takes knowing the market, the investors, the potential buyers, what their expected returns are on both the business and the real estate, because we massage the rent to meet acceptable markers for the business value. That parlays that rent into a cap rate that we predict in order to derive the real estate value. So we are working between the two, not to stress either one and to maximize the combination of the two. So that is part of the work that we do in an industry specific valuation. But good explanation, Mike. Thank you for that. Let's talk about financing. Let's run through this pretty quickly because we've got a couple of good questions. But we heard most of our guests today talk about growth from the respect of buying real estate. So fantastic. We had about an equal mix of traditional financing and SBA financing. We heard a little bit about about half of purchasing were thinking about landlord. And then we had a small community that was thinking about REIT partners. Can you just give us any additional commentary on these options?
Yeah, you bet. So the traditional financing works great for those operators or investors who have an established relationship with their local bank. There's usually a local decision maker. There's a certain appeal of going in and speaking with somebody across the desk. Those banking relationships and those banking terms will still probably require some form of personal guarantee. But I feel like if you have an established relationship with your local bank, and I don't mean Bank of America or Wells Fargo, but local community bank, those can be very fruitful relationships, and you know the decision maker. If you don't quite fit into their underwriting basket, however, then the SBA can be a useful alternative. The SBA is well known in financing childcare acquisitions. The SBA will be a little more flexible on some of the underwriting. The SBA has been known to look at projections, which many traditional banks, they only want to look at historical. Now, the SBA process can be cumbersome. We have a lot of complaints about the process. We have a lot of complaints. You can't find anybody to make a decision. It's time consuming. But once the loan is achieved and given, then it's a lot of the hard work is behind you. We have heard some grumbling about some of the lockdowns and the restrictions on payment for SBA. So you have to weigh the pros and cons of that. For those who are looking for growth with using somebody else's money, then third-party landlord is a very attractive method, and landlords are always seeking tenants to occupy their building. And if you're looking to grow and have established a relationship with the landlord, then why not use somebody else's money to own the building, and you can expand your business and not get your capital tied up. For those that are usually larger, usually more sophisticated operators than the real estate investment trust, that's what the REIT stands for. Those are large national companies that sell stock to the public, and they are seeking to invest in triple net leased buildings where their job is to own real estate, and they're seeking qualified operators. But you generally have to be larger because they have tighter credit requirements. So usually 25 schools or more, then you graduate into the REIT world.
Great. Thank you. Thank you for that, Mike. Couple of quick, sorry y'all, I always forget to look at Q&A and I'm get hung on chat. Couple of quick questions. The calculation is 70% of the potential revenue of the building. So if the building was 70% occupied, in a quick math, and Framework will do it for you, is to take your license capacity times your average tuition rate. If you're a weekly biller, multiply it by 52 weeks, and then multiply that by 70% or 0.7. That's the potential revenue of the building at 70%, then multiply that by 15%. Also the question, do you take into account the whole building space, stairwells, kitchens, office space? Yes, you do. You have to pay for it all, so yes. Is the license capacity taken into consideration when establishing rent? Yes, it's the licensed capacity. There are a few exceptions, but very few. For instance, Florida, some providers are grandfathered under an old capacity per square foot rule, but use your license capacity because you could put that many children in your building. There are reasons not to, good reasons, to not ever go to the exact number, but you could, so use that number. If you're considering selling your business and you are netting about $600,000 to $700,000 per year, how do you determine the value of your business? I am 100% of the business owner. My husband and I together are the property owner. We would need to know a little bit more. So if you're netting $600,000 to $700,000 without paying yourself rent, we would work on a market rent for you that would show you then what your real estate is worth. And then that would determine what your business was worth. It also depends on who owns the business. So there are a lot of factors that go into that decision, but that's something we would be happy to support you with. So Mike, let me see, I think we have real quickly, talk about using real estate for growth, and then we have 2 questions I don't want to miss.
Okay. So for those who are contemplating growing, the first angle to look at, of course, is making sure that your existing building is being used to the maximum capacity. And under organic growth, in my opinion, comes with making sure your existing facility is as optimized as best as possible, and then considering using landlords as your vehicle to grow. On greenfield, brownfield, what this means is greenfield refers to ground up in a vacant parcel. You're going to start everything brand new, fresh. You get to design everything from the get-go. Brownfield means you're taking an existing building, whether it's childcare or a retail shell, and converting it for your use. And the last one is acquiring somebody else's business or building, putting it under your brand, and continuing to operate under your brand.
Fantastic. Thanks, Mike. I'm going to skip interest rates for right now, and because I want to be sure we hit these. You touched on it a bit. So Ashanti has been very patient. She owns 2 schools and is in negotiations to sign a LOI to build another location from the ground up. In the meantime, a turnkey opportunity came available to lease a school. Assuming the numbers work and it's a good location for expansion, would it make sense to lease a 3rd location and keep capital freed up for the coming new build?
Well, I love the fact that she's asking, it looks like a lady, that she's asking, would it make sense to lease a 3rd school and keep capital as opposed to or? So we always like that concept. Yes, I think if there's an opportunity on a turnkey center in your market area that could easily be converted to your brand, that seems like a low cost of entry to me. I'd want to make sure I understood that the reason why this center is available is because of a temporary problem that happened to the former operator, or is it a permanent problem with that location? That would be my first investigation. And then, yes, I love the idea of keeping your capital for the new ground up location at some point in the future.
Right, that would make the possibility of both available, right? And agree that taking over it, I'm not quite clear if there's a business operating in it, but is it successful currently? Was there a problem in the past? Is it a good location? Is the population that you want in the area? Okay, one more. Do you think buying the property can lock you into a space that can be a location not suitable later on? Maybe it's perfect today, but perhaps not in the future. How do you think about that, Mike?
Yeah, I think that's a concern. That this is what I referred to earlier. What if the neighborhood changes and you're in that space? If you're a tenant, then you ride out the lease and you don't have to renew. If you own it and the neighborhood changes, then what do you do with it? Because you've got a special purpose building that's suitable for preschool and it's not suitable for most other uses. So I think that's why folks are careful when they think about owning a building. They really need to look not just in the next 12 months, but the next 12 years.
Fantastic. Well, that was a lot of information, Mike, and I really appreciate your time in helping our guests understand how they can use their real estate as a growth tool, how it works best to set them up for financial health in the future, and how to strategize that if they're growing or exiting. So thank you for your time. Thank you, everyone, for joining us. Please reach out if we can answer specific questions. If you want to know what metrics look like for a specific opportunity, we're happy to give you a quick opinion of things that you might be looking at. So certainly reach out. The recording will be provided tomorrow if you would like to review this. And we appreciate you guys. Thanks for joining us. And we hope to connect again soon. Thank you, Mike.
Thank you. Take care.